Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today is the second video we're doing with Chris Richard, who is a portfolio manager at BCV Asset Management, Inc. out of Winnipeg. So today we're going to be talking about kind of the five must-have or five qualities you must have to invest in a dividend mandated portfolio. So if you're someone thinking about investing in dividend growth stocks, like how does it look? What qualities do you need? And let's hear from a professional, someone that does this as a profession. They invest in dividend growth stocks. What do they look for in companies? And it's going to kind of guide you in the right direction and give some clear kind of understanding of how they think, how they look at companies, and again how they the five must-haves for investing in a dividend growth stock. I'll introduce Chris Richard here in a minute, but if you have any comments, questions, post them below. We probably won't be answering as many as usual because we'll have Chris answer them in a future video down the road. So what we're going to do is kind of gather all the questions that you guys have and then release some more videos down the road from Chris answering those questions for you. So if you have questions about investing, portfolio, that kind of stuff, put them below and we're going to kind of amalgamate them and we'll put those in a future video. Chris Richard is a portfolio manager that works for BCV Asset Management, Inc., a registered portfolio manager, investment fund manager, and exempt market dealer that is independent from Parallel Wealth Financial Group, Inc., but works with referring advisors, much like myself, to provide discretionary portfolio management services to our mutual clients. Okay, so Chris, in this video, we're going to talk about the five principles of investing in dividend growth stocks. So I know, we've been working with you guys for a long time, sending clients to you guys for a long time. I know you guys have five key principles. I'm sure a lot of dividend growth, investing firms and just in general would have similar philosophies, I would hope. But let's go through the five. So number one is value. So talk about value.
Sure. So BCV stands for blue chip value, and that really is kind of core to our beliefs. I mean, we really want to focus in on paying an appropriate amount for each individual company. Now, I mean, BCV, we're not focused in on, you can't buy a company more than 10 times earnings, price to earnings ratio. Earning value is relative to growth, right? And for us, I would expect to have to pay more in earnings or for the value that, say, a Microsoft would provide than what, say, a Bank of America would provide. Just the fundamentals of the business are different. We want to focus in on companies that are growing and that have stable cash flows and great business prospects for the future, but we don't want to pay too much for it, right? I mean, it's kind of, we always say we want all these great things, but we don't want to pay too much because really the total return really does focus in on what we paid for that business. And sometimes we think businesses are undervalued relative to the market, and other times we think businesses are expensive. It really comes down to those fundamentals. But in brand core belief of ours is we don't want to be overpaying for businesses for the fundamentals that they provide.
Yeah. Okay. The second is quality.
Yeah, so for us, I mean, we're firm believers in this, right? You want to make sure that you buy quality businesses because you never know when the next hiccup in the markets are going to happen, right? And when you buy quality businesses, we want to make sure that we focus on businesses that have got great cash flow, phenomenal balance sheets. Quality businesses are also run by really exceptional people, right? We want to focus in on those characteristics. The universe of investing is so large. We screen it in for what we like to look for because really quality we find over the long term of investing really does, pay, right? We want to focus in on that and hold the best businesses that we can have. And quality does tend to, do well over the investing horizon.
Okay. And the third principle of investing in dividend growth stocks, and I know we talked about this in the last video, but it's dividend growth.
Yeah. So that the dividend growth is almost like a byproduct of checking all those boxes that we just talked about, right? You got a strong business model. If you've got, very limited amount of competitors, if you've got a strong management team, if you've got, great growth prospects, chances are you have the financial maturity in order to pay your investors a dividend. And if you also check all those boxes with having some growth within your business, you're able to reward shareholders with dividend growth, right? So, and that's kind of the secret sauce, is to make sure that we have those businesses that kind of check all those boxes in order to continue to grow that cash flow. Like we talked in the last video, though, we want those growing cash flow numbers to be rewarding shareholders with a higher dividend from that growing cash flow number, right? We don't want to just have a company that's saying, hey, we're going to pay you out, 5-10% more per year. but then the cash flow to the company is the same every year, because eventually that's just not sustainable. The sustainable dividend business model really does lend to having a really nice long-term horizon of investment in a company, because it checks all those boxes and it rewards shareholders over the long term.
Okay, perfect. No, it makes sense. And as any investor, I think we want to be, if you're investing, not trading, but investing, I think you want that long-term reward, which again, dividend growth to me, and obviously to you, it's probably the best way to get that. So the fourth one, and this is probably the biggest fallback to most investors, especially on the DIY side. But so the fourth principle of investing in dividend growth stocks is patience.
Yeah, so I mean, we're not high frequency traders here at BCV. We focus in on holding businesses after we've done the research. I mean, we're our own research in-house team, and every portfolio manager looks at their set of businesses. But when we bring something to the investment committee, we say, where is this business going to be 3 to 5 years from now, right? And we buy a business looking out that far, right? Patience really does tend to work when you buy a great business at a great price. And if you're able to kind of hold that business over a long period of time, that's usually where you get a good rate of return by buying the right business and holding it, right? We never want to kind of just set it and forget it, though, right? We don't want to just say, oh, we bought this business 10 years ago and it's the same business, right? It's always kind of, okay, is it still the great business that we have there? We kind of used CN Rail as the example last time. Same thing, right? Is if you bought CN Rail, it hasn't changed materially. It's still a railway in Canada that moves goods, right? So if you invest in it, and as long as it doesn't get too expensive relative to what its prospects are, holding it over a long period of time makes tons of sense. What we do see as well on some clients is they say, oh, something's gone up 5%, I got to sell it and capture my gain. We're a firm believer in letting your winners run, right? If it's a great business with great fundamentals, and there's nothing really that's changing that, we're long-term holders, right? There's a lot of businesses, BCV was founded in 2007. There's some businesses that we continue to hold since 2007, right?
Mm-hmm.
We used to have clients that have bought them at lower costs, and they continue to be these phenomenal businesses that we can continue to hold and continue to grow and put into client portfolios.
Yeah. And we have some clients that have been with you guys for 10 years. And when we meet for review with them, when we look at their portfolio, there's some stocks that are up over 300%. Like, they've done, and that's rare. Yeah, I get that. That's rare. But, you can see just patient buying at a good value, being patient with it. And I always tell DIY investors, I mean, we talk to a lot of you, on YouTube here, you give us a call, you say, I'm a DIY investor. I'm just looking for a financial plan. I always say to DIY investors, again, I'm not licensed to do the investing side of it, but I do know the philosophy behind it, in that it's really easy to buy a stock. It's much more difficult to know when to sell a stock. So, patience isn't just on the buy side, it's also on the sell side.
Yeah, I mean, for us, when you buy a stock, usually to get into a BCV portfolio, you're a high quality business, right? Mm-hmm. We don't buy companies that are somewhat on the fringe. We tend to focus in on really great businesses, and we know them really well, right? Because we hold, concentrated portfolio. And when something comes out of the portfolio, it goes to our investment committee team, and we say, like, listen, is this now one of the best companies that we can buy for clients? And sometimes the answer is no, right? Sometimes the value of that business is over what we think it is worth. But that's the beauty of markets, right? As soon as we sell that business, there's someone on the other side that's buying it, right? So someone else obviously thinks it's a good buy. Yeah. But selling the businesses that are high in quality, it's difficult, right? Because you just know what they are. But that's why that's what we do, right? Is we want to focus in on holding the best companies, and we want to make sure that we're paying an appropriate value for them. So sometimes that does mean selling, but yet over trading, that sometimes does not usually lead to success for clients. It's sometimes that second guessing, and listen, I get it. Like, the financial markets, it's complicated, right? Sometimes to some people it's a black box with numbers moving across the screen up or down, and some people think it's at random, and that's kind of where we want to focus in on just getting to the nuts and bolts of what we're buying, what we're holding, and really what we're paying for this business.
Totally, yeah. And the fifth principle behind dividend investing, dividend growth investing is, and you mentioned it, is concentration. So just talk about how you guys at BCV create concentration and how you build portfolios.
Yeah, so I mean, we don't look like the benchmarks that we track. we're not going to look exactly like them. We focus in on certain characteristics, and everything within those benchmarks don't check every box that we look for. So we don't want to look like the benchmark, right? We want to look for businesses that identify to us as being sound investments. So we hold a concentrated portfolio. We want to focus in on never investing in like 200-300 stocks in client portfolios, because chances of them all being checking all the boxes probably not there, right? So we want to focus in on the best businesses that we can find for clients and invest in those, right? So we think that holding a concentrated portfolio of great companies run by phenomenal people, and an appropriate value, does lead to great success over the long term. So that's why we think that. I mean, some people, if you buy an ETF, you're going to be the market, right? But for us, we really don't want to be the market. We're an active management firm, so we want to make sure that we're buying the best that we can find. And by doing that, you hold stuff in concentration. So it's not we're never going to have, like I said, every sector equal weight to our benchmarks, but we don't think that we need to do that to have a good long-term success for clients.
Yeah, and concentration isn't, just so viewers are aware, it's not buying 5 companies. You guys usually own between 40 and 50, right?
Yeah, about that. I mean, we want to make sure that we diversify away individual company risk as much as we can, right? So you want to hold a portfolio, and usually that happens at about 15, 20 stocks, depending on literature you're reading. So I mean, we're not going to buy 3 companies and just say these are the best 3. Yeah. We want to get also diversification in sectors, right? I mean, Canada, we invest in banking currently. But in Canada, there's not a great healthcare stocks to usually invest in, not of the size that we like. Right, so we kind of say okay, our portfolio is concentrated. Here it makes sense to invest in Canada in these types of companies. In the U.S., we've got great exposure to industrials, to healthcare companies, to technology companies. That Canada has a few, but not quite as much of a deep bench there.
Mm-hmm. No, for sure, that makes sense. And I remember years ago doing a course on investing. The risk, the diversification kind of risk factor. It's like a hockey stick. Like once you hit that 15 to 20 stocks, whether you own 20 or 4, like once you hit 20, you're diversified enough, essentially. It might be up to that 30, 40 mark, but a lot of people think, well, no, I have to own, 500 companies to be diversified. Or the other mindset that a lot of people have is I need to be invested in, RBC and like in different firms or different, buckets to be diversified. And that's not the case, right? Essentially, good diversification can happen as early as 20, 30 companies that
We find that a lot of clients, and this is not ubiquitous across everybody, but we find some clients, they buy kind of our previous conversation, and then they just seem to forget about it, and then the next money that they have, they buy something else because it's good. We really want to focus in on that concentration because we want to be core to our beliefs that we want to hold the best, right? In our opinion of what the best investment is. So in doing that, if you have a number for concentration within your portfolio that we have, it forces you to have that conversation, right? Not to say hey, it's okay, and we've held it for a long time. We really want to have that conversation. Is this really check all the boxes still that we want to hold for clients? And by having concentrated portfolio, it forces us to have that conversation.
Yeah, no, exactly. Perfect. Well, thanks for this, Chris. So again, that's the 5 principles of investing in dividend growth stocks. So hopefully this information helped you guys out. Again, these are the 5 principles that BCV runs by. If you have any more information or want any more information on BCV, reach out to us, info@parallelwealth.com.